Hello and welcome to our Investment Playbook series. Thank you for being a part of today's event. If you're a new participant, thank you and welcome. We promise to make it a time well spent. And if you're a returning participant, thank you for always coming back. Before we go any further, we have with us the MD, Managing Director of Afrinvest Asset Management Limited, Christopher Omo, who is going to just take us through the opening remark before we go into the crux of today's event. Hi, Chris.
Thank you, everyone. I'm delighted to welcome each and every one of us to today's webinar. As we can see from the topic is very critical to our investment decisions for the remaining part of the year. Turning points, repositioning for optimal return. And I'm very sure that all our facilitators are ready to share with us our thoughts and our investment strategy towards helping us position ourselves for optimal return for the remaining part of the year. I'm sure that at the end of today's presentation, each and every one of us will be able to get all that is required for us to make the right investment decision for the remaining part of the year. As you may be aware, there are a lot of macroeconomic changes. There are issues regarding macroeconomic changes in the economy. And I'm sure our facilitators today will be able to explain all the details to us today. Sit tight. There's going to be a session for question and answer. Get your questions ready. And I'm sure facilitators will be here to answer all your questions. Thank you so much for joining today and happy listening. Thank you.
Thank you so much, Chris. Thank you. You have made my work as the moderator quite easy. And as Chris has mentioned, we are going to be discussing what has happened in the market for the last 6 months, and we're going to be giving our insights on what we expect in the market for the next 6 months. So we've seen a lot of things happen, both domestic markets and even global markets. Looking inwards, that's domestic markets, we'll talk about policy reforms following the inauguration of our new president. And when you look at the broader market, we've seen inflation that has been in our faces for most part of the year, and even last year, begin to decelerate across major economies, and how that has also affected the market. All of these, my esteemed colleagues would be walking us through all of them. And then if you have questions at the end, please feel free to use the Q&A chat so that we can attend to all of your questions. So this presentation is split into 4 parts. We are going to have the first part that will be taken by Raymond Opara, which just talks about the global markets. Then Temitope Omosu will be taking us through the domestic market and our outlook. Babajide Atolagbe will be talking us through the markets, that's the domestic and global market. Why Robert Omotunde, who is the CIO here at Afrinvest, will be talking us through the other part of it, including the theme of today's event, the turning point, and how we can properly position our portfolio for optimal return. If you have questions, to the chat box, and as always, we are going to share the slides with all participants at the end of this webinar. So without further ado, Raymond, you have the floor.
Okay, thank you, Victoria. I'll be taking us to the global macro scene for H1 2023 and our outlook into the second half of the year. So starting from inflation, what we saw was that generally consumer price levels, weakened throughout H1 2023. And majorly we saw that global economies benefited from, firstly, favorable base effects and also a much food prices, all of this which formed the major drivers as seen a year ago. Also a year ago, particularly, we also saw, some crises in Russia and Ukraine, and that also fueled, inflation levels. But this year, we've seen that inflation is now on the path to 2%. Although not there, we see that it is on the path. I'm just talking sovereign specific. We saw that inflation, US inflation in June came in at 3%. Right, this just further solidified the Federal Reserve's efforts to rein inflation, and also across UK and the Eurozone, you've seen that consumer price levels have generally weakened throughout 2021, and all this is still positive for markets. You've seen how several policymakers and governments alike have embraced these inflation numbers as validation that their policies are having the desired effect. Has fallen, while goods are not still talking about how central bank policy inflation still runs heavily above, includes generally volatile food and energy, stays stubbornly elevated, and we've seen that have been fueled by the service sector, it has been elevated. You've seen how demand for services still, very, households are still feeling motivated to make up lost experiences from the pandemic. I just go financial sector turbulence earlier March. We saw that the Credit Suisse bailout in Europe, right? This just to reassess market conditions and also gauge responses of regulators to this systemic risk that we saw from the bank failures, right? And as we see on the chart, the S&P Bank Select Index saw a decline, a depreciation in this sectors index. And just for more context, we saw that firstly, Silvergate Capital, a bank that focuses largely on cryptocurrencies, declared in March that to liquidate assets following a bank run compelled to sell off some of his debt instruments. And seeming you also saw SVB being company and on the deposit, right? And that was very notable because the failure of this we've seen since the 2008 financial crisis, right? Majorly loan withdrawals. And just to go across Europe, we can also see that Credit Suisse, also had some liquidity issues. And on the March 15th, to be more specific, we saw a stock falling by 24%. Across financial markets, and the system came from the state bank. And at the end, to see that you consider the in Switzerland balance sheets at fast policymakers and general and global central banks came to the rescue of these banks. And we believe that the banking sector is better capitalized than we saw in the 2008 crisis, and this is positive for the markets. We don't expect bank runs from banks to largely affect the markets. Yes, we might see some short-term declines, as I see from the index. Investors trying to reassess their positions, against fears in the market. But we believe that the market is well capitalized, to weather any storms that will come from some turbulence. And just for global growth, what we saw in global growth, that generally we've seen how higher rates, and also issues from the banking crisis have affected, and drastically slowed, economic growth for major players, being global economies, right? And from forecast to saw from the world, we're seeing how forecast for growth, just generally broad-based downgrades, right? And even from our chart for 2023, growth is expected to be at 2.4%, from coming from 3% in 2022 and 5.9% in 2021. Right. Also, merchandise trade volume is expected to drastically decline, from 9.3% in 2021, coming down to 2.8% as our last year closed, and for 2020, it was at 1.7%. Right. We've seen general themes have affected this, right, including the recent banking crisis seen in the US and Europe. Also, we've seen how higher interest rates, have increasingly, put some restrictions on credit conditions, right? And these have affected emerging markets and developed economies alike, right? And according to the World Bank, all we've seen also is that this fiscal weakness would, deliver a heavy blow to low-income countries, all right? And from the reports released earlier in June, you see that 14 out of the 28 countries are now in debt distress, or are at a high risk of debt of the debt distress. And 1/3 of these countries, are expected to see their per capita incomes, in 2024, remain at 2019 levels. This is rather worrying, but the economic conditions just play out, in this tone. Pre-COVID levels, we see how there was a steady GDP growth and also merchandise trade, but COVID-19, dealt a heavy blow on economies, and we see that decline. 2021, there was a little respite. Markets generally, we saw trade volumes going up, but 2022 and 2023 came with their own, issues, and these have affected, global growth, and we've seen that pain, that pain point for for global economies. And just going on to, monetary policy actions, trying to draw a line between, economies that we've seen that have been, more hawkish compared to others that have been dovish. We've seen that, major central banks started in their rate hiking cycle 18 months ago. And all in all, we've seen that the US Fed has raised rates by 500 basis points, with expectations of further rates, giving their data-dependent stance. On the other hand, we've seen the Bank of England, raise its policy interest rates, amounting to a 475 basis points through their rate hiking cycle to 5%, just to battle high inflation. You understand how UK had, faced high inflation above 10% over the course of this period, and now inflation numbers are coming in rather positive, just to show that these policy actions have been rather fruitful for them. If you also look at economies like the ECB, that have dealt with persistently high inflation, their ECB interest rate currently reads about 4%. And also back home, we've seen how the CBN has been aggressive, a total of 700 basis points, to 18.5%, just to battle inflation that reads, at approximately 23%. But if you look at other economies that have been dovish, just highlighting China and Japan. For China, the case is that China is still coming out from, its COVID-19 levels, trying to get their foot in world economies. And we've seen China, rather dovish, just to, boost the economy. So for China, we saw that China even slashed its prime raise by 30 bips as early as December 2021, right? The lending rate now prints at 3.55%. Similar case for Bank of Japan. The Bank of Japan has left the short-term rates unchanged as minus 0.1%, just to maintain its easing policy. And we've seen how these economies and respective inflation numbers have responded in relation to the actions that they've taken. And just to go for our outlook into the second half of the year, firstly being inflation, we believe that we expect headline inflation to continue retreating in H2 in absence of any shocks, right? As global economies would benefit from favorable base levels, and also the large gains have also been wiped out. The large gains we saw from energy and food, these have been wiped out from the annual CCI, computations, right? But if you look at monetary policy guidance, right, you've seen that more talks of rate pauses or rate slashes are now coming onto the table. We've seen with developed and several emerging markets having begun rate hikes as early as 2021. There's some possibility of rate reduction just to promote economic growth, and that is now on the table now. Rate slashes are more likely than ever because we've seen that inflation numbers are lower. If you look at the US, for example, inflation at 3%, and the Fed at end of year target at 3.2%, is already beating the expectation, and the talks for rate reductions is now on the table, right? But for China, on the other hand, China's year has not been the best. If you look at the manufacturing numbers, the services numbers, China is still struggling to come out of, its COVID environment, right? But for us, we believe that to be rather premature to write out China 2023 in a whole, right? Even while we expect that China's growth to decline, against market predictions, right? But what we've seen for China's case is rather different, right? China is characterized by some moderate level of government debt, and I believe that this will help China to further push out stimulus that they've discussed earlier last month, right? It just gives the Bank of China, more leeway to reduce interest rates, and this will strengthen household and businesses, due to their very low inflation level. So we believe that it is too early to write out China. There still exists a large range of market opportunity in China. I believe that these numbers will change, given that the economy is boosted as expected. You've seen so much talks on stimulus, you've seen so much talks on rates cuts, and this is positive for China's market. I think that's the end of the market review.
Thank you so much, Raymond. Thank you so much for that. So, Temitope, I've heard a lot from Raymond. Would you say we saw similar patterns here in Nigeria, and how would you advise us to navigate the next quarter?
All right. Thank you very much, Victoria. I hope you can hear me, right?
Yes, we can.
All right, fantastic. So for the Nigerian economy, we have seen series of shocks in recent times as well. And for us, in fact, I think the turning point is also speaking to Nigeria as much as it has something to do with what is happening globally. So for the Nigerian economy, right, we have seen significant shocks in the last 8 years, ranging from the major recession in 2016, another recession in 2020, Russia-Ukraine crisis worsened the economic performance in 2022. In addition to that, we've seen other, domestically induced shocks, from border closure to the ban on 41 items by the CBN, among other issues that have continued to affect doing businesses in Nigeria, ranging from multiplicity of tax. All of those, unsurprisingly, have kept our growth, in the last 4 years to an average of 1.42%. That is rather abysmal, because compare that to a population growth of 2.6%, is largely inclusive. No wonder an average Nigeria complains a lot that it seems GDP is growing, but we cannot feel it. So this is why I think that the administration has shown a bit of commitment to achieving 6% economic growth. Because if you look back to pre-2015, right, this level of GDP growth corresponded with low level, or I would say relatively low level of unemployment, because prior to 2015, Nigerian unemployment rate was barely 12%, but now we have over 30%. So with this focus for the new administration of about 6%, then I think we are on track. In addition to that, I think it's also very important to stress that the non-oil sector has been the major driver of the Nigerian economy, in the last 8 years, and particularly the transition happened in 2020 when the oil sector declined substantially. No thanks to the COVID-19 shock that led to a major energy crisis, and the sector has really remained under the waters, for a very long time, now in recession. So we believe, and we have advocated, this strongly, that for Nigeria to achieve the level of growth that is inclusive, because we believe that 6% growth is achievable. As a matter of fact, we need more than a 6% growth to achieve the level of sustainability we are looking at. So we believe, and we have advocated, that a balanced growth is needed for Nigeria. And what do I mean by that? We need an economy where the non-oil sector and the oil sector are contributing optimally to the Nigerian economy. And now moving on to how this has affected Nigeria's fiscal condition. We observe over time that Nigeria's fiscal sustainability condition has also worsened, and this is not, so surprising, because government can only make money from the fraction of economic activities, which is why if you check the revenue to GDP ratio, it used to be over 6%, it went to 3.7% in 2014 and went down to 2.5%. Why? Because the economy is not thriving as expected. So, which is why budget deficit also worsened, because government is not getting enough. They had to borrow a lot. As a matter of fact, in 2015, budget deficit was barely 2 trillion, but now we are talking about over 7 trillion. And we all know that government has to finance deficit through either printing of money, sales of assets, or borrowing. And Nigerian government has really embraced borrowing, which has led to increase in debt stock. As a matter of fact, we can see there that debt stock to GDP has increased substantially from barely 30.6% in 2014 to over 36.3%. And that is very alarming, because it's inching towards the threshold of the IMF for developing country. That is about 55%. and for advanced economy, 60%. So investors are looking at all of this. So at this point in time, it's very critical for the government to begin to make certain decisions. Some of them we have seen it, and the government has even stated before the march that Nigerians would feel the impact to be negative in the immediate. However, it has a long-term impact. For instance, in Afrinvest, we have been able to estimate that on the one hand, government will save some money from over 2 trillion from subsidy. In addition to that, the net impact of both gains from oil earnings and cost implication of debt service will give government more than 350 billion. So all of this will support government, in terms of the budget deficit. However, this must be addressed as urgent as possible because we are inching towards a condition that economists will call the debt trap. So moving on to some of the recent issues that we have clearly presented in this capital importation narrative. The concern recently has been about the unification of the currency and the fact that the I&E window, the investor and exporters windows, is now close to the parallel market rates. We did a bit of study on that. We observed that in the period where the divergence between the parallel market and the official rates are close, we get huge capital importation. And it's also the other way around if the divergence is wide. For instance, 2017, when the divergence between the parallel market and the official exchange rate was declined from 166.5 to 59.2, we saw major improvement to capital importation across the board. But after that, in 2020, we saw the huge jump, and we saw that jump till even the end of the year, and even till lately before the currency unification, and the result is quite clear. As a result of this huge divergence, capital importation has been on the decline. In fact, Nigeria cannot even boast of about 1 billion in terms of capital importation. So by and large, we believe that the current unification, even though it has created a bit of disequilibrium in the FS market, we believe that it could yield some positive, impact. As a matter of fact, we are beginning to see the impact on the financial market, which my colleague will touch on as we move on. So now let's take a brief look at, monetary policy. Monetary policy is very critical to what is happening at this point, ranging from how inflation is going to be addressed. We've seen surge, in inflation over 22%. This is one higher than threshold that the CBN said 6 to 9%. And it's also way above the 12% that have been stated even by the CBN to be injurious, to be inimical to the economy. So we saw that, yes, the CBN at some point, similar to what was done in advanced economy, increased interest rate. But the fact that we are adopting a kind of counterintuitive, approach had made it less effective on inflation. For instance, if you look at our correlation analysis, obviously, when NPR, prior to 2015, the relationship was the orthodox. When interest rates increase, it's expected that inflation will drop because the idea is for us to mop liquidity in the system. But after 2015, all the way down to the most recent policy direction, the relationship has been positive, meaning as interest rate is going up, as you're increasing NPR, inflation is not responding. And the singular reason for that is because, one, we are looking at how this Monetary Policy Authority has consistently supported the government through ways and means, and the singular objective of interest rate increase is to reduce money supply. So we believe that, yes, so long we are able to address all of this, in addition to food and energy security, we believe that inflation could decline somewhat above 20%, but decline somewhat towards the tail end of the year, and going forward into 2024, we can begin to see a bit of deceleration once we are able to address energy, food security, and the direction of money supply. So on exchange rates, we are also very particular about this. We understand that this administration is largely committed to 550 and 600 exchange rates in terms of the outlook within the next 8 years. This is not just going to be achieved in the near term. However, we have certain views. We believe that this, even though it is achievable, but it is premised under on certain conditions. foreign reserves must improve. And for the major sources of inflows to foreign reserve is capital importation. You look at remittances and inflows from oil earnings. So we believe that all these parameters must improve before we can even talk about, achieving a major appreciation, to the naira, to get the naira stronger. So that will bring me to the end of my presentation. Victoria, over to you. Thank you.
Thank you very much, Temitope, for that very insightful presentation, as always. Babajide, it's time for you to marry everything. We've heard a lot from both the global and domestic. How did markets react to all of this information?
Yes, thank you. I mean, the markets definitely had its own fair share of the spoils. Given the macro narrative that my colleagues have clearly explained. I mean, the case in point is the global equities market, which had about 2 different performances in the first half of the year. I mean, in the first quarter, we saw that prices were relatively lower due to the effect of higher interest rate decisions taken by central banks. And this also coincided with the period where the banking crisis occurred, right? So all of this put a threat to the financial stability of the entire system. And as a result, stocks were selling off at a significant margin. And shortly after this happened, we began to see inflation numbers moderating, providing some sort of comfort to investors. And the Fed also came out to run some stress tests to the banks, which brought about improved confidence to the general markets. And that was what was largely responsible for the uptick we saw in global equities in the second quarter of 2023. And just to put some bit of color around it, I think the US market was the major contributor to the major uptick we saw in global equities on the global front, right? For fixed income, the reaction was largely mixed, right? So despite the fact that inflation was moderating and core inflation was still sticky, so that put fixed income traders on the edge, right? We also saw central banks still pushing out hawkish comments despite improved macroeconomic numbers. I think some of those comments were basically on the back of the difficult conditions of the job market, right? So it is understandable. It is understandable. So fixed income space was largely mixed. In the developed market, we saw yields still trend high, while in the in the sub-Saharan market, some country-specific factors drove yields downward in that regards. And the case in point is Nigeria Eurobond market, which saw premium interest towards the towards the end of the second quarter, given the new pro-market policies that were rolled out by the new administration. So the market was largely mixed across the board. And going forward, we expect to see moderation in yields globally, given that most of the central banks have reached their policy targets, and inflation on one hand is also getting back to pre-pandemic and pre-Russia-Ukraine levels. So a lot of comfort will be ushered into the market for investors to speculate. I mean, just to travel around the world to look at global currencies. I mean, following the hawkish policies we saw in in the first half of the year by developing markets, right? Most of them their currencies responded positively. And if you recall, in our last call, we explained that the dollar is largely overvalued in our opinion, given the fact that the price appreciation we've seen was largely fought by the Fed's disposition throughout 2022, right? So, I mean, in 2023, we had expected that most of the gains that the dollar had, wrapped up will be, will fade out, and that has actually played out in the first half of the year. Looking at the currency baskets, I mean, the top underperforming currency under our basket is Nigerian naira, and the reasons are not far-fetched due to the devaluation exercise that Temitope had, clearly spelled out earlier. Egypt also suffered some, downward trends in their, currency, given the economic challenge that the country is currently grappling with. Meanwhile, despite the capital control measures that Russia actually, handled to, curtail the flow of capital out of Russia after the war, I mean, the currency still suffered about 20%, 20% decline in the first half of the year. While other currencies like the Brazilian real, the British pound, franc Swiss enjoyed some level of good interest, given the improvements in their exports and their export position. For commodities, it's a mixed market, to be honest. The energy space suffered good losses to the tune of about 10-15% on an average. For Brent was down despite the fact that Saudi Arabia provided some level of supply cushion to the market, right? I think the major worry in that market is the recession fears, which investors are beginning to doubt the demand forecast for 2023, given the fact that China's reopening has not been really fantastic or nothing to write about. So, the energy market clearly reflected that investors' concerns. For the precious metal space, the gold was the only major outperformer there. And we could tie that to the fact that the risk environment was largely heightened in 2023, and investors prefer to stick with the precious metal to hedge their positions. Meanwhile, the country-specific factors affecting supply and demand dominated agricultural space for the most part of 2023 H1. Let's just bring it to the global real estate space. The real estate market also enjoyed some significant improvements despite the moderation we saw in 2022. The fact that central banks, the frequency and the level of rate hikes we saw in 2023 were not as high as 2022. That brought about interest in the market. And if you look at the REIT tracker, the developed market outperformed due to activities in the US. Meanwhile, the Asian market underperformed due to the challenges in the Chinese real estate market. Digital asset also once again showed why investors continue to take them as a interesting space, interesting alternative space, as Bitcoin actually gained about 85% in the first 6 months of the year. Other digital currencies also thrived in that manner, and the market gained sufficiently well above the S&P 500 and other traditional markets. Pretty strong performance there. Coming home to Nigeria, the fixed income market was largely driven by the liquidity dynamics we saw in the market. Also, we saw the fact that investors priced in the impact of the new policies that were being rolled out by the new administration. Those policies were termed as policies that could enable market participants speculate better. And on the back of that, we saw treasury yield and bond yield actually moderate down to reasonable levels, so single-digit levels, treasury bills, and also for the bond yield, average yield fell to about 13.4% from about 14.5%. Reporting good gains for. In terms of what we should expect for fixed income market for the rest of the year, you still think that the government impact is still likely going to affect the disposition in that market, because the government has indicated that they want to run a low interest rate environment. However, some fundamental factors still suggest higher yields. Take, for example, the inflation levels, spiraling inflation levels, and the fact that the government still has to borrow more locally, to fill up the deficit that the government has. But we'll continue to watch how that space performs as we move very quickly to the domestic equities market. The market, was, had a very interesting session. Globally, it was among one of the top 20 equities markets that outperformed in 2023. All these gains even started in Q1, not even before the election. Not even the new administration came on board. In Q1, the market had already done about 10%. As investors were clearly prepared to take advantage of the undervalued stocks in Nigeria, and Q2 just put more butter on the bread, as the market actually gained over 19%, right? following the pro-market policies that the government introduced, and also the fact that we saw increased participation by foreign investors. All of those factors drove sentiment in the market across sectors. I mean, oil and gas sectors, banking sectors, consumer goods sectors had good outing. Virtually all sectors of the economy enjoyed interest, save for the insurance sector. I mean, the drivers for the market for the rest of the year. Fundamentally, we think that there are some risk factors in the market that we speak. There are some factors that are largely to affect margins of companies. Factors such as some of the hardship or the pains that comes from these policies. Take for example inflation, and how inflation and demand being slowed due to consumer disposable income moderating over time. So we think that margins might be slightly affected, but from the tech perspective, the market still remains largely undervalued, and the fact that we have foreign portfolio and we have foreign investors participating at an interesting rate, we're likely to see that support the market to the positive side. And I think that's enough about the market. Victoria will just pick it up right from there.
Thank you so much, Obajide. I know you have a lot to say. If I leave you all day, you can keep telling us about what happened in the market. I'm sure our participants are waiting to hear our expectation for the next half of the year, covering all asset classes and investment options available, majorly just trying to tell them how to position for optimal return. No better person here on the call to do that than Robert Motunde. Hi, Robert.
Thanks, Victoria. My pleasure to take us through this very important session. I mean, Raymond, Temitope, and Babajide, they made the work so easy for me. So I believe I'll just be cruising, telling us what to do with our funds so that we can get the best of returns for the rest of the year. But just to take it further, I think we should have some questions at the back of our mind. Three poses, I would say. The first is, why should the US Fed, or why is the US Fed hell-bent on keeping interest rates higher for longer? Because that has been the phenomenon that shaped the market so far in the year. What are the precursors to the major reversal we expect in terms of policy rate? And how will investors react to the policy shifts? These three questions will guide my conversation in this particular section as to what the market thinks. And if you go back from a theoretical point of view, there's this link between economic growth and inflation. Economists believe most of the time that when inflation is rising or when the economy is growing, it comes with it some other inflationary pressure. And that is what is beginning to shape the market in the last 2 years, as we have seen. Perhaps inflation was not caused by growth-related factors in the first instance, but because we had a major global shock from a geopolitical crisis that we experienced, Russia and Ukraine war, the consequence being inflation and spread all over the world, from the US to the UK, the ECB and the likes. Now, the normal, in which case you will see economy growing and then, we have some natural inflation, attending that. May not be the case in recent time, as we have seen that even though the different central banks have been applying stiff measures, as we will call it, hawkish stance in managing inflation, in some regions or some jurisdiction, inflation remains very stubborn. While in some other regions, we are, putting a rein on it in some form. But I mean, moving away from that, in terms of the divergence from turning point, because we're trying to bring together in this particular session what we refer to as the turning point. From a global standpoint, inflation becomes that, turning point phenomenon that we are looking at. The reason for that is, for instance, take the US Fed that has consistently hiked interest rates over the last almost 1.5 years now. And you're seeing the impact on inflation, the headline inflation coming as low as 3%, just 1% away from the target of 2%. For other major systemic central banks like the Bank of England or the ECB, the target is still far off, given the application of higher interest rates. But I mean, the economy is gradually getting towards that point. And in this second half, we think that that turning point, that inflection point is going to be established for higher returns for the fixed income market and the other asset classes as inflation take the back seat. I mean, take the US Fed, for example, the path to inflation targets, for pivoting monetary policy, for example, we expect that before the end of this year, the US Fed is still targeting some additional hikes in interest rates. For us, we think that our projection will be perhaps we will see 3 more hikes in the sequence of 0.25, 0.20, and of course 0.15. But notwithstanding that, market has its own formation as to what to expect as far as interest rate is concerned. And if I am to take us through the drivers, when you consider inflation, interest rate, geopolitics, and growth, we think that the turning points are already established as far as inflation is concerned. And that implies also that we already have a perception of what the turning point for interest rate should be. For geopolitics, we don't think that it will get, more worse than we already have. And for growth, of course, we are not expecting that the economies will slip into recession. We may see periods of slow growth, notwithstanding. Now, that said, it then means that in terms of expectation for different asset classes, fixed income, equities, commodities, and currencies, what we would expect is that for fixed income, for example, moderation in inflation, end of rate hike, as well as geopolitics and economic growth, are expected to be positive for the fixed income market, as we are beginning to see, by the way, because as inflation is moderating, the fixed income securities are being appropriately priced, more like we're going back to the normal, as against the aggression that we've seen across markets over the last 18 months, I would say. And of course, we've seen the impact of this on major banks or some banks in the developed market. We saw earlier in the year, the SVB bank failure, which of course is not unconnected with the fact that as inflation is rising and monetary policy authorities are raising interest rates, it's impacting on, asset prices, which of course is now suffering in terms of, value. For the equities market, we'd expect a mixed reaction for each of these turning point factors we highlighted. I'm talking about the inflation, end of rate hike, geopolitics, as well as the economic growth. We would expect that there will be a mixed reaction for both equities and of course commodities. However, for currencies, it may all be negative, especially for major developed economies, because what you would expect are some reversals. You may expect some reversals to happen as emerging markets and frontier markets are beginning to recover from the recent shocks that we have seen. Now, that takes me to how you position your portfolio for the so-called optimal return. You recall at the beginning of the year when we preached our investment strategy outlook, we had mentioned about 6 different strategies, from muted downside volatility to market timing, valuation, repricing, cautious trading, portfolio rotation, and of course, diversification. If you followed us religiously, and you've attempted to apply all of these philosophies, which were preached at the beginning of the year, by now I'm sure you would have been smiling to the bank, because definitely for assets, we've seen muted downside volatility. It's been more volatility to the upside. Of course, market timing can never be overemphasized, as we have seen valuations repricing across asset classes for equities, for fixed income, both in the developed market and, of course, in the local market. And we said that diversification is very key, which, of course, inform our, different asset classes that we are advising investors to, pitch into, from fixed income, which we allocated about 50% to real estate, 20% equities, at 15%, and of course commodities at 10%, as against 5% allocation to the other asset classes like PE and venture capital. Now, what this emphasizes is the fact that if you are a fixed income investor, we believe that at this point, your allocation to sovereign instruments should be around 65%, as against 35% allocation to corporates. And if you're playing as against what we preached at the beginning of the year, where we said, you should be long to the short end and play less on the long end. I think at this point, what you should be doing is to have more allocation to the long end of the yield curve as against the short end of the yield curve. And of course, your activity should be balanced. You should not be too aggressive. Now, I like to blow a bit of our trumpet. If you look at my next slide, which is talking about allocation to the sub-Saharan African market, this was where we preached and we recommended specific instruments for you to invest in. If you did that at the beginning of the year, you will see that you will have made some very good gains, especially when you speak to Nigeria's markets, the sub-Saharan Eurobonds market for Nigeria. And that is across both Nigerian sovereigns and corporates. We've not seen good performance for Kenya and Angola, which were part of our recommendation. But of course, the optimism is that they will pick up in this second half. So we maintain this recommendation. And if you are looking at investing directly with us, one way you can do that is for direct Eurobond purchase. As we said, we'll share these slides for you to have them. You can also invest in our Afrinvest income portfolio with a minimum amount of $25,000, as we show. Afrinvest dollar fund is also a way you can invest in. Of course, Afrinvest discretionary portfolio, which is a new kid that we are, talking to at this point in time. And on the local market, if you invested in the portfolios we recommended, you will have done north of 13% on the average, given the allocation. You see that, as Temitope mentioned earlier, there is a turning point at the local market as well, where you have then, beginning to see policy shifts, which is then impacting in a positive way on the overall market. For the alternatives, equity strategy first before the alternative, we think that the opportunities are still very much here, not just in the global space, but also in the local market as well. And so if you look at our recommendation at the beginning of the year, where we said we put an eye on the value, if you invested in our equity portfolio at the beginning of the year, you are not on the average over 30% across instruments that we recommended. We still have upside potentials, for these securities, and we still keep them very close to our chest. And for the developed market, we still have new set of recommendations, which you get access to by the time we are sharing some of these other slides. So on the alternative strategy overall, we believe that market still presents good opportunities in that space as well. Real estate, private equity, commodities. The only thing we preach in this particular space is caution, and the fact that sometimes they may come with illiquidity, so you may need to, watch your liquidity needs before you invest in them. So I have the honor of bringing this presentation to an end as I hand over back to Victoria. Thank you.
Thank you. Thank you so much, Robert. It has been an incredible journey so far, exploring the world of opportunities that lie ahead of us. This is time for Q&A. So if you have questions, please use the Q&A chat. That makes it easier for us to be able to see your questions and ask the questions. Okay, so we have a question here. Excellent presentation by the experts. Thank you so much. What's the impact of all the numbers of equity investment in sectors like transport and power sectors and cement? So I think Jide can take this question.
Thanks, Victoria.
Please clear that research recommendation.
I mean, the body language of the new administration, like we rightly mentioned, has been pro-market. I mean, we've seen an instance where the government is giving everyone an open field to come and do business and expand the Nigerian economy and change the tides of the Nigerian economy over the next 8 years, right? And the initial reaction we've seen from the equities market suggests that investors are quite excited about that. And I would say the impact has been felt on a broad-based level, right? All the sectors, I must say, has enjoyed or benefited from the inflows from foreign participation. For the power sector, I still think that there are a lot of opportunities in that space. As we are sure that one of the government's priority is to improve power, and the guys in the power space are likely going to benefit from future policies in that regard. And for what cement I can see for the industrial sector or the cement industry or what have you, I mean, the last 8 years, we can see that the last government has been pretty much friendly towards investment in infrastructure, right? And that has really that drove a lot of activities on that side of the market. As you will see that in the industrial goods sector gained about 90.7% in the first in 2022, which is kind of significant. And we still think that that trend is still going to continue, as infrastructure is also one of the key area of focus that the government wants to address, and we believe that will translate into some sort of positive momentum for industrial stocks. I believe our research report that speaks on sectorial discussions will shed more light on company-specific factors. You can just check our website to read up on the reports to catch more insights on that end.
All right, thank you so much, Babajide. We have another question here. What's the level of participation of foreign investors in Nigerian equity markets in Q2 2023 compared to the same quarter in 2022? I think Tope can take this one.
All right, Victoria, thank you very much. Though, if you're looking at foreign investors' participation, we've largely discussed how we think participation will improve, right, this year. And we only saw a blip, I'll call it a blip of that, last month, when we saw that in the equities market, the participation was, I think, was over 300 billion. I can't remember precisely, but in fact, it went viral that the participation increased by, 100 times, right? But because it's actually coming from a very low base, what is happening generally in the market is that we are seeing more of foreign investors' participation. However, we believe that with the current, policies that are addressing, factors that have kept investors on the sideline, on the back foot, we think that the participation will increase. As a matter of fact, I highlighted when we're talking about domestic markets, how capital importation, usually improve when there's close divergence between the parallel market and their official exchange rate. So, the major chunk of capital importation, especially when investors have not gotten, a clear understanding of how policy direction will pan out, is portfolio investment, and these include bond, OMO, and the stock market. So we believe that the sentiment, the participation will continue going forward. So largely, it was really a better performance towards the tail end of Q2.
Thank you so much, Temitope. We have another question here that I'll be directing to Robert. And this question just speaks to asset classes. Is there any asset class that can serve as edge for inflation in Nigeria at the moment? And I'll be pairing this particular question with your expectation for MPC meeting. This is one of the most anticipated MPC meetings. So we want to get your expectation for that meeting at the same time. Over to you, Robert.
All right. Thank you for giving me the most difficult one to answer, but I'm glad to answer it. Okay, first, as it is right now, inflation is printing at approximately 23% in Nigeria as we speak. And if you look at the offerings in terms of available assets, the best bet to still beat inflation in a relatively safe manner, this mark my word, relatively safer manner, is still the equities market, because the highest yielding instrument in Nigeria today for the longest tenor instrument within the fixed income space for the sovereign instruments is currently at around 14.3%. So even if you get some additional premium in the event that you are investing in a corporate bond or any other corporate security, you probably could get close to 20%. But 20% actually is very optimistic. You know, you may be having between 17 to 18%. Once you start getting any, issuance, given the current interest rate environment that is paying above 18 and closer to 20%, you should begin to get worried and, check the quality of that instrument. The quality is something that you will need to watch before you delve into it. But if you must beat inflation at this point, equities seems to be your best bet. But again, remember that equities come with a lot of risk as well. So today, market has printed something fantastic. Maybe a way to be able to cautiously invest in equities to consider investing in equity funds. Afrinvest, for example, has what you call Afrinvest Equity Fund, which is, a fund that is primarily targeting equities. That fund has done over 30% year to date. If you had invested in it at the beginning of the year, you sure would have beaten inflation, right? So it might be your way to really diversify and invest in an equity-based instrument. The reason is because if you do that, you don't also have to bother about, managing the portfolio yourself. That's why you're investing in a fund, because you have professional investment managers who will monitor that. Secondly, on the MPR, it's a bit, difficult to preempt the body language, I would say, of the MPC at this point in time. For Nigeria, we have to look at the fundamentals vis-a-vis the body language of the Monetary Policy Authority. As we can see, after the last central bank governor was asked to, was suspended, what we are seeing now is some sort of coordination between the Fiscal Authority and the Monetary Authority. And from the body language of the Fiscal Authority, it appears as though they are trying to get interest rate as low as possible. We are seeing that in the markets happening, for the treasury-based auction and the bonds auction that have occurred since this new government, came into being. We've seen interest rate moderate from time to time. So it is expected that at the next MPC, because there is this seeming coordination between the Monetary Policy Authority and the Fiscal Authority, we may actually see MPR coming down. A policy stance reducing MPR, even though I'm able to say that may not be fundamentally justified. And that's why I say there's a difference between fundamentals now and the body language. Fundamentally, inflation is still higher than, 22%. So there is no reason why we should continue to see lower interest rate. But because liquidity dynamics and the supply side factor, the fact that the government is still the biggest player in that space, that factor will continue to play out. So it will not be surprising to us to see MPR come down at the next meeting. But even if MPR doesn't come down, market rates will continue to go down, because that is the signaling that the market is already getting from the current government. Thank you.
All right, thank you very much, Robert. Permit me to just ask one more question. This will be the last question. Please, if we were not able to ask a question, just so that we are going to answer them, you can always send it to us, aml@afrinvest.com. We'll also put that in the chat box for you. Send all your questions to us and we will provide answers to them. So the last question we'll be taking for today, I'll direct it to Temitope. It's talking about the possibility for federal government to be able to achieve stability in the exchange rate, especially given that FDI is currently low and short-term bills are not as attractive to foreign investors because of the negative real return. So do you think it's possible for the federal government to be able to achieve stability in exchange rate?
Thank you very much, Victoria. I know that questions around FS markets and the outlook for exchange rate is very, very dear to an average Nigerian, because when you go to the market, what you hear is dollar has gone up and all of that. So it's quite correct that, because of what is currently happening, you may want to doubt the stability of FS rate in the near term, say 1 to 3 months. However, it's typical of all policies to have a kind of disequilibrium just within 1 to 3 months before investors will now begin to look at, parameters. What do I mean by that? They will look at what is happening to government export earnings. All of those new numbers will begin to show, alluding to the fact that the current policy is now affecting, is affecting the economy and affecting reserves. So what will bring about the stability is improvement to reserves. And what are the components or sources of reserve? We are looking at remittances, right? We've talked about the US economy, the stability in those economy. That will, and other advanced economies, more Nigerians will send money home because the disparity in the market has declined in terms of oil production as well. We've seen improvement from December, less than 800,000 barrel per day, over 1.2 at the moment. So that is a second point. And the last one is the fact that what investor wants is unification, and they get it. So which means even though in the next 2-3 months you may not see the stability, but we are likely going to see that before the end of the year, and it could continue going forward because we are seeing the right policies that foreign investors are interested in.
All right, thank you so much, Temitope. I've seen a lot of questions asking us if we are going to be sharing the slides. Yes, the slides will be shared. Even the presentation will be uploaded on our YouTube page for everyone to go and check. So before we go, would like Chris Omo to just give us a bit of thanks, and then we'll call it a day. Over to you, Chris.
Thank you, Victoria. And thank you, everyone, for attending this webinar. Just like Victoria said, we are going to be sharing both the slides and the video via email. We want to appreciate everyone for attending. Please keep your questions coming. All the questions you have sent to us in the chat box that we're not able to answer those questions, you can send them to us via email, aaml@afrinvest.com. aaml@afrinvest.com. I want to appreciate everybody for attending. Thank you. Please keep the questions coming. Let's continue engaging ourselves, and we hope that before the year runs out, as you invest, you are going to witness the optimal return as we discussed. That's all we have for now. Thanks so much for attending. Let's have a nice day. Thank you.